Thank you, first of all, L&T, for having me on this dais here today. But I must start with a caveat. I am neither a techie nor an AI expert. Having said that, I just thought I'll start off with, are we getting the slide here? Yeah. So I'll just start off with talking a little bit about our approach to AI. I think first things first, hugely excited about the transformative potential of AI, but I must also say that when it comes to credit risk, most certainly it's peppered with a lot of caution. We are very excited about the usage, but before we get into the discussion, I'm just supposed to kind of introduce our approach to AI. I think from our perspective, very clearly what we are seeing is the ability now to use very large data sets versus the traditional models, then the ability to create many more new variables than we used to in the past with the traditional models or traditional data sets, and most importantly, the speed to do all of this. So the way we are looking at AI really is to enhance what we do already today. It is not some overly revolutionary theme of a complete overhaul. And last but not the least, I think it is super important to understand, first of all, where the lending industry fits in this world. The starting point is where we are today. So if you look at where we are today, when you talk about regular data science and analytics, you will see a huge spectrum across the board in terms of evolution, in terms of stages of adoption of analytics itself. If you look at the lending world, look at the kind of scorecards being used today or number of scorecards being used today, I think we are still at a very beginning stage, which also makes me kind of make a point that it's an interesting transition from this world into AI. It's a bit of a leapfrog, I would say. And that's why over the next few minutes, as we have our discussions, I'm going to be talking about what kind of caution and an iterative approach as we go through this transition. I think I'll stop there and wait for the other panelists. Thanks.
Thank you so much, Mr. Kumar, for your insightful remarks. I would request you to please take your seat for now. We'll have you back on the stage for the panel discussion shortly. Now, ladies and gentlemen, I would like to call upon Mr. Sachin Seth, Regional Managing Director, CRIF India and South Asia, to share his thoughts. Let's give him a big round of applause, everybody.
Hi, everyone. Good afternoon. Sachin here. Thank you, L&T, for inviting us for this August gathering. As you know, this panel, which is supposed to be immediately after our sort of initial pitch, is all about how to make credit underwriting better and use of AI, right? So I'll probably just give a point of view from CRIF perspective that how we are looking at use of AI in better risk management, better underwriting, use of data, etc. And then obviously there'll be more questions in the panel discussion. So can we move the slide, please? Yeah. So just some introduction. Many of you are working with CRIF already. So CRIF basically provides the full stack of decision sciences, or you can say the credit underwriting and insights. So we do have basically the CRIF mark as a brand, which is the bureau, the MFI bureau, consumer bureau, and the commercial bureau. Then we have CRIF Connect, which is the account aggregator, along with bank account score or statement analyzer kind of model, or open banking kind of model. And then we use basically a lot of data science to see that how we integrate both of them using all the technology, right? Now, so I'll just talk about specifics of that, what is our point of view on use of AI, ML, and such kind of stuff in the credit underwriting space. Next slide, please. Yeah. If you could give me the pointer, that would be better. But yeah, so what I'm going to talk about, see, I think in one of the so I think I was listening to some of the speakers earlier, and I think one of the word was used that, if you have a hammer, you don't need to really look for a nail, right? I mean, so AI does not mean that you have to fit AI everywhere, right? If there's a nail, you need to find a hammer, right? So same thing, even I am going to put it in a way that when you do credit underwriting or credit decisioning, while we have technologies like AI, ML, and we have a lot more coming up, whether it's a chat GPT, Gen AI, et cetera, does not mean that, we have to use all of it. I think it's all about making right decisions. So just a perspective I want to share that, if you look at two areas which are the core of underwriting, one is credit bureau score, and second is basically the banking analytics, which is using the account aggregator model. This is where you are able to, if you look at credit bureau score, by using certain models of ML, you are able to improve Gini by, let's say, about a 5% or so. We have seen that, and we can get into more discussion about it. If you talk about banking analytics side of it, that's also become very powerful because the segmentation and the categorization of basically income and expense side of it has also become a very good input for the integrating into credit underwriting and analytics part of it, right? And I'll just give you a little bit more dope on that. So in this case, what happens is that, the sharpness can be brought in the underwriting, whether you are using a custom scores or whether you are looking at a standard scoring model. And with more than 50 crore Indians data is starting from microfinance till, let's say, commercial side of it is already existing with the bureaus. We are able to actually refine it further and bring that 5% upside on the Gini. Right? And that's a significant sort of improvement in the underwriting with so much of data already being available. If you look at it on the banking analytics side also, basically you can get early warning signals, you can do better capital management, you can do better collections, and even, that's an open banking value-added service which integrates with the bureau, and that is where even Forrester has recognized it as one of the differentiating factor. So how does it work? So if you look at it in the banking categorization model, which I'm talking about in the open banking perspective, basically we look at that the ML models are used to look at different set of categorizations, different set of spends which are there, and I think it brings a lot more sharpness in terms of that, how your customers, financials are behaving, right? How the income, and the more you are able to categorize it better using ML, the better you are able to basically predict that what would be the sort of behavior of the customer. And the same is basically used to see that how the AI models can be created on top of it, and that's where basically we can then institutionalize it. So that's how the integration is working between the both. And I've just put down that, food and drink, entertainment, travel, education, every kind of basically expense can be categorized using a sort of banking score model and integrated with the bureau score as well. In the bureau side of it, so basically bureau sizes that we do have basically a lot of products wherein indexes have been already built, whether it's a two-wheeler score, whether it's a custom score for, affordable housing and things like that. And that is where what we are doing is that looking at the holistic data of the bureau, you are able to get insights that, how your potential customer can behave. And that's the Gini I was talking about for the 5% improvement, right? So in this case, again, but the regular validation and the governance is very important. And that's where we work with clients like you to do that. And this basically also uses machine learning models to be able to provide that kind of a Gini, right? So this is a short presentation I wanted to share. I'll be with my sort of eminent panelists together with here and would basically look forward to answering any questions. Yeah. Thank you so much. Thank you.
Thank you so much, Mr. Sage. I request you to kindly take your seat for now. We'll have you back shortly for the panel discussion. Up next, ladies and gentlemen, is Mr. Kedar Kulkarni, co-founder and CEO of HyperVerge. Sir, may we please have you on stage? Ladies and gentlemen, please welcome him with a big round of applause.
Check. Yes, thanks everyone. Thanks for being here. HyperVerge is an AI company.
We started in 2014. We started as a group of research students out of IIT Madras. And over the period, I think we used to represent IIT Madras and India in robotics. After some time, it became very clear that we have been kids in a toy store working on very academic problems. And in 2014, we decided to work on a lot of real-world problems. And that's what brought us to BFSI. And if you can go to the next slide, please. That's what brought us to BFSI. We are one of those unique companies that is bootstrapped. We had raised $1 million in funding, but never raised anything after that, and have been doubling in revenue initially every year and then every 2 years. One of the few companies that is profitable. HyperVerge has done 1 billion KYC checks. So all of us, when we need to open a bank account or a brokerage account or a credit card, or if we need to engage in any financial product, I think KYC is a process that we all do. Have you all gone through this process? And you remember how this process used to be a few years back? We would always submit an attested Aadhaar or an attested PAN, and it would take like a couple of days or a day to get those things activated. Today, in fact, if you walk into a telco like a Jio or a Vodafone, there is a 80% probability that by the time you walk out of the store, your SIM card is already activated. Or if you use any of the new age lending apps, or if you use any of the new age brokerages, you will mostly have your loan approved or the account open within few minutes, if not within few hours. So I think that's a process that HyperVerge powers. When we talk about 1 billion, it's about 1/8 of the world's population that has gone through this. It means that the technology has to work not just with 5G, 4G networks, it has to work with 3G and 2G networks for a country like India. It also means it's not enough if it works on very nice devices like iPhones and high-end Android phones. It should work on a phone that costs $5,000. So these are the places where HyperVerge has had to really, really push to make sure that this kind of a number happens. From a technology perspective, I think we all love digital, but the moment you go digital, we also are exposed to a lot of fraud. So there are so many different type of fraud attacks that happen. Today at 5 p.m., in fact, we have a demo which we are going to do on deep fakes and how deep fake based fraud happens. But as we evolve, so do the fraudsters, and there is a lot of work that needs to be done to prevent them. So HyperVerge, be it the face recognition tech which NIST certifies, or the anti-fraud tech that organizations like iBeta certify, HyperVerge has been a leader, one of the only people from India who regularly participates and regularly brings back good ranks for our country. In terms of enterprises that work with HyperVerge, we have 100+ banks and NBFCs that work with HyperVerge. L&T Financial Services has been an amazing partner in this journey. So obviously starts with them. We have 7 out of the top 10 brokerages in the country that work with HyperVerge. Almost 50% of all general and health insurance is on HyperVerge. And very simple applications that we don't think about on a day-to-day basis. If someone is delivering a Swiggy order to you or an Instamart order to you, how do you know that it's the same person who was onboarded on the platform and not a friend of theirs? So lakhs of drivers that drive for Swiggy, Zepto, etc., they go through a random identity check at some point in the day to ensure that we as customers are safe. So without us knowing, there are a lot of places where this technology gets applied to ensure that we all can have safe transactions. Looking forward to the panel. Thank you.
Thank you so much, sir. I now invite, ladies and gentlemen, our moderator for the upcoming panel discussion, Dr. Gautam Sanyal, advisor, L&T Finance, to the stage for his remarks on the panel discussion. Sir, can we have you on stage, please? Ladies and gentlemen, give it up for Dr. Sanyal.
Good afternoon. So, I have some questions that naturally occurs to, I think, most of the people when people look at credit assessment, credit risk assessment, and AI. And if we can go to the next slide. So, first question is that will AI replace all the human underwriters? I think this same question came about when first credit risk models were introduced about 3 decades back. But except few segments, we still are not in a position where credit underwriters, human credit underwriters have been eliminated altogether. They're still there. With the new wave of AI, the same question has come back, that will AI make the human credit underwriters redundant? Second question that comes to mind is, does it have the potential to surpass the human expert level of performance? Now, even 20, 30 years, since last 20, 30 years, there has been few studies to see whether models can match the expert human level. Limited experiment with credit managers underwriting the same cases and models underwriting the same cases. From the few studies and experiments that we have seen, the broad understanding is the model beats about 95% of credit managers, and 5% of credit managers, possibly at times 2-3% credit managers, do beat the models consistently. The problem is that all human credit underwriters, they believe that I am that 2-3 underwriters. So on an average, credit models do beat, but not all credit managers. Now, if you look at the current wave of AI, it's all about Gen AI, particularly with the advent of ChatGPT, right? But if you look at it, and if you deeply look into the subject of credit risk assessment and credit scoring models, this historically has been about predictive modeling. So the question that comes to my mind, that the recent wave is all about Gen AI, and historically credit risk assessment is about predicting the default, predictive AI. So how do they marry? How do they gel? And when I look at literature, except certain limited studies, maybe there are studies happening within the industry, but I'm referring mostly to the published researches. There is limited study on the efficacy of AI, the modern AI on credit underwriting, and the results are mostly inconclusive. So it's an interesting area to look at. But however, having said that, there can be very important use cases which is not trying to probably holistically trying to predict a default or credit risk assessment, but in the whole credit process, there could be very important use cases that can be tackled by AI. And last but not the least, explainability and bias has always been issues for AI models. And we know that being in a regulated industry, the explainability and the bias is one of the most important aspects looked at by regulators and other stakeholders in general. So we will hear some answers to some of them and the views from our expert panel in the next few minutes. Thank you.
Thank you so much, Dr. Sanyal. I request you to kindly remain on stage as we welcome our panelists back on the stage. Mr. Rajesh Kumar, Mr. Sachin Seth, and Mr. Kulkarni, please come and join us on stage so that we can begin the panel discussion.
I think we need to come.
Welcome back on stage. Over to you, Dr. Sanyal.
No, there's no one. So, my first question is to Rajesh. Rajesh, how CIBIL is using or planning to use AI in the entire process of credit assessment? I know CIBIL has got a score and many other areas of modeling and analytics. So how is CIBIL using AI or plans to use AI in the coming days?
Hanji. Thank you. I think, first of all, for me, I start with when you have a new technology on hand, I think you start with an assessment of what is the change that's required. None of us change anything in our lives for the heck of change, right? What are we really trying to solve? What are we trying to achieve with AI? Right? I don't want to change for the heck of change, right? But having said that, you can't, the power of AI is so much. So first is the thought process. So my thought process really starts with what's the new problem on hand when it comes to our market, our economy. I think the real problem is that, I don't mean problem, it's the problem statement, so to say, is that today we have a huge change today versus when Gautam ji and I were actively managing large portfolios in our prior stints. If I look at 10, 20 years back versus today, what's the difference in the marketplace? I think the first real difference is obviously Indian demography, right? The young population is much bigger in number, much higher in terms of percentage. Then if you look at the loan books today, in the past I remember our 6 metros used to be 60-70% of the book. That's very different today, right? The tier 3, tier 4 books are much bigger than they used to be. Then the socio-cultural habits, right? We all used to start with first we want that home loan, and then the next 10 years we paid most of our salary paying off the home loan. But with the young population today, there's a lot of change. It's more lifestyle based than wealth creation based habits, right? No, these are tectonic shifts. Now, why am I talking about this in this forum? I'm talking about it in this forum because there starts the first question. The data, before we go to AI as a tool, the data that we have today as lenders or as credit bureau, does the data reflect these changes in the first place? If we were to go to 10 banks or NBFCs and look at their dashboards and MIS decks, would the data there reflect these changes in the first place? If it's not, we got a problem on hand. Then that's about the new variables. You can talk about AI and you can talk about creation of a whole lot of new variables. If it wasn't captured in the first place, what are we going to really build on, right? So I'll go at it sequentially. So first is the availability of the right data that reflects these market real changes that are here to stay. It's not a 6-month fad, all that we spoke about earlier. That's the first thing. Then the second thing is when you look at what really has changed and you look at underserved segments that we talk about, because in India, credit penetration is very low. For our economy to keep this growth rate, credit has to grow. They say that between credit growth and economy, there is a 2 to 3 times as a ratio, right? Typically, the credit market grows at 2 to 3 times the GDP growth rate, and I suspect it's a causative factor both ways. Right? It's not a one-way causative factor there. So coming back again, if that's the kind of growth rate that we need, then the low credit penetration is a problem to solve. Which means if you have to increase the credit penetration, you have to go deeper into underserved. Now we'll go back to my first point about is the data ready, are there the right variables available? And then let's come to the second point and link the two. If you want to go deeper into underserved, then that necessarily means we go deeper into bank statement because established credit information by definition is not available, which means you're talking about bank statement information, UPI information, GST information. By definition, all three are hugely voluminous. We don't know how much is noise, how much has value, right? From a lending perspective, it doesn't matter if you went to Starbucks twice a week or twice a day. Is it relevant from a credit risk perspective, right? So whole lot of text mining, which means your classification of data, the categorization of data, and then taking out the meaningful sets of data and linking it to the right customer segments, right? And to To do all of this, absolutely, I think AI is going to be hugely useful because we can handle much larger data sets. We can work with 2 to 3x the kind of variables that we used to work with. But obviously, that brings me to the last point that through all of this, right? It is when you talk about underserved, etc. It's a whole new segment. We all worry about biases, etc. From our perspective at TransUnion CIBIL, I think our real focus is to ensure we serve the objectives that I've stated so far. How do we use the new technology, get the right data to solve for higher penetration? And in that, the one point to add before I hand over back to Gautamji is, I think the very customer segmentation. When we talk about underserved, I worry about the age-old customer segments. It's the same for the last 10, 15, 20 years, right from the loan systems of the bank. Today, a good example is when we talk about MSMEs. Lots of work to be done on credit penetration into MSMEs. We talk the same micro, medium, which is based on turnover. I keep thinking that with AI, with this kind of data available and the new tools, segmentation is something that we have to annihilate, the existing customer segmentation. We don't need to term them based on turnover, based on your income groups or your SEC classical classifications that have been existing since my college days. It can be A1, A2, A3, it can be B1, B2, B3. It's just a whole lot of mix of a new set of information that has relevance, absolutely notwithstanding any possibility of a bias. I think I'll stop here and wait for the next.
Thank you, Rajesh, and nice to hear from you about the new way of looking at segmentation from the classical ones. I'll come to Sachin now. Sachin, digital lending is the order of the day, and now we have this wave of AI. How is CRIF looking at this, and what are the opportunities that you are exploring?
Sure, thank you, Gautam. So first of all, Rajesh has already stolen the thunder. So whatever is left, I have to now add to that. So thank you. So Rajesh did cover entire spectrum of things, but I'll probably try to take it to next level of sort of, deep dive. So what we see at CRIF is that, first of all, obviously any kind of digital lending, what we are doing comes with a higher set of risk. Okay, because your decision making is quick. When you are making a quick decision, you need to have enough amount of data in the system with various sort of parameters to be able to make a decision which is going to stand for the logic on which it is made, right? Now, having said that, I'll classify this into 3 parts. So first and foremost, when we talk about AI and use of that, and I did cover briefly in my presentation, see, if you look at it, products like, say, two-wheelers, CD, if you look at products which are very standard credit cards, any kind of such products which are combination of secured, unsecured, typically what happens is that when you're making a decision, if you bank on a bureau data, which is obviously stands the test of the time, but by using certain amount of machine learning, what we are able to do is that probably 5 to 10% improvements we can bring by doing certain kind of indexing. Okay, so what I mean by indexing is that, let's say, if you are using a score, you have built a model on top of it, but if you are already also working with bureau to basically see that how can I get certain attributes which are of a certain cohort. Let's say Karnataka is having a certain amount of delinquency, or let's say UP has certain amount of delinquency in certain categories. Now, these are the things you have to collate the data yourself, and you have to keep refining your models. But if you are looking at bureau to provide, there are ways to do it that you can actually build scores on top of it, and wherein that index scores will be able to help you refine that part, which is 5 to 10% of, let's say, reduction in the bad rate, or let's say uplift, depending on which side we are looking at, right? So that's first. Second, also, I did talk about open banking. So very powerful tool today in the underwriting is available is use of account statement analyzer with open banking through account aggregators. In CRIF, because we are one of the unique player wherein we have account aggregator, open banking platform as well as bureau, and within the boundaries of the regulatory framework, we do work with the clients to see that how we are able to look at categorization. And that's what I mentioned that, looking at categorization through machine learning is very important. We have seen that in use of account statement analyzer also many times players are not able to look at even whether the salary, which is a recurring payment or a pension or some kind of a rent, if it is not having a unstructured classification, you are not able to do it. But that's where we have built the models of ML, and we are able to basically classify. Once you classify that, you are able to actually put the risk in the right category, right? And that is also able to help you significantly in terms of your underwriting along with the bureau data, right? So that's the second part. Third part, Rajesh covered very, very, very well. Again, what happens is that if you look at MSME segment, the income streams are not consistent. Today, when Zepto becomes popular in Powai, which means that 30% business of Kirana stores in Powai has gone down. Now, which clearly states that a Kirana store having taken a loan is basically will have a certain amount of difficulty in fulfilling that, right? Possibly. But if you are using an account statement analyzer along with the bureau as a cross tab, you will be able to see decline in the income and you will not wait for delinquency to come, right? And you will be able to do early sort of collections, or you will be able to decide that whether you do upsell or cross sale of the loan or not, right? So I just wanted to go a little bit deeper into it and say that use of ML specifically along with the AI models, we are able to do this kind of sort of innovation. And that is what basically will be able to make underwriting more sharper.
Thank you,
Thank
Sachin. Kedar, how do you see the use of alternate data in credit assessment and also during onboarding KYC aspects? And at HyperVerge, you must have seen various lenders and across different geographies, right? So would you share some experience in the space of this use of alternate data and maybe an overlap with AI to the extent it is happening today?
So when we think about alternate data, the most important thing that all of us are thinking is how can I have more information when I underwrite, or how can I create better underwriting decisions, how can I have a better portfolio, how can I have lower NPAs. There is a completely different aspect to alternate data that I wanted to bring out. In the course of onboarding so many customers, right, we regularly go and ask customers, hey, what is it that you want? In this room, if I ask all of you, right, we all deal with financial products, what is it that we look for? I think the first thing that I get from everyone is, I want to do minimum number of inputs, minimum number of steps. I don't want to keep putting data 1, data 2, data 3, data 4, data 5, right? Minimum number of things you can ask me, that's great. The second thing that we consistently hear is, I want the decision to be faster. I don't want the decision which takes 2 days, 3 days, and I'm waiting on it. Because then I don't know, should I apply with some other company? Should I wait on this? So I just want the decision to be faster. Third, I think we are at an age where we want the decision to be logical, where if, for some reason I'm rejected or my interest rate is high or whatever, I get to know what is the reason, right? So I get to improve that parameter over a period of time. And I think the fourth thing that we want is, I don't want upsell and cross-sell calls coming to me, right? If I am using one product, I don't want 10 upsell, cross-sell calls coming to me all the time about every product you have, right? Maybe when I have a need for a product, I would want to reach out to you. Or if you intelligently understand what product I should now use, you reaching out in a personalized way is okay, but not a generic way. So one of the uses of alternate data, if we go by this pattern, is to really, really personalize the experience for the customer, right? If we know that, hey, so many things I can get about this customer, I can reduce those inputs, then we prevent customer drop-off. Every step where we are asking the customer to give one more piece of information and one more piece of information, it's a drop-off point, right? We actually see it on our dashboard. Every time you ask customer for some information, it's 5% gone. So these are hard-earned customers, money spent in marketing, downloaded the app, and you lose the customers. Similarly, when I look at alternate data, if I can use that to personalize the upsell and cross-sell experience, it's hugely valuable. So I would just point out that alternate data like it powers better decisions from a credit underwriting perspective, if we can use it to personalize the experience so that it's not a one-size-fits-all, I think that's going to be very powerful.
Thank you, Kedar. It was extremely useful. I'll come back to Rajesh. We need to be also mindful about the time left. Rajesh, you have handled the largest portfolio, retail portfolio ever in the country. And so I want to know from you, from very practical standpoint, particularly in case of AI, when we hear about inclusivity, fairness, these issues. From a very practical banker's point of view, what would be your experience and what would be a couple of suggestions that you would like to make?
I think I'll go back to what you said in your initial presentation, right? 15, 20 years back, the same questions that we were trying to answer when we first got into scorecards. And then we went on to implement some 200-300 scorecards in the organizations we were working for. The questions remain the same. In the interest of time, I'll be rapid. I think first things first, it is super important to understand what is sitting in our development set before we build models, be it AI or the regular traditional models. What is sitting in the data set, in the development set, versus what are your business objectives. Simple example, if you do 60% of your business to existing customers in metros, you built a model, but then 3 months later, you're trying to grow your business in deep geo with open market customers, there's a mismatch. We keep using the word bias on extremes in terms of diversity or whatever, discrimination, but I think there are lots of biases as these that I'm giving an example to that we don't pay enough attention to. And then moving on quickly, the overall governance, to build any model, I would spend maximum time on the assumptions and definitions. I don't care much about the statistics, etc. There are people much better qualified than I am, but I would spend a lot of time on every single assumption and definition in the scorecard building process. Moving on quickly then, in the implementation, I think the early and quick feedback, the feedback loop, every case that goes bad subsequently, where was the decay from the probability of default of a 2%? When it happens, it's 100%, right? Where was the decay? Which variables went? So that quick monitoring and feedback loop. And I think lastly, the deployment too. We talk a lot about models. Over my 3 decades today, I know that probably the right deployment is as important, if not more important, than the sheer models. I think I'll stop there, Gautam.
Thank you. Sachin, I'm going to change the question a bit here from what we've been discussing. You have shared what CRIF is doing, and so what are some open use cases, may not be live, but possible using AI in the credit space that comes to your mind?
So thanks, Gautam. So I think, yeah, obviously this is a space everybody is evolving, working with the clients. So it's nothing that CRIF has done is full and final. It's a journey. But one of the things we wanted to share, I want to share is that we have done about 70, 80 POCs, wherein we have worked with the clients to see that if you are using, again, I will go back to the same point that, bureau versus other sources of data, which is bank score, etc., etc. And how do you basically use these models to basically expand the sort of risk bucket? So let's say if you are saying that 2% bad rate, now can that 2% be multiplied by 3 and say 1 to 6%? And then as an underwriter, I can make a choice that whether I want to pick up that 1% or 2%, because that 2% is accumulation of 1 to 6%, right? So using open banking and account statement analyzer, we are able to do that. And I think Mr. Rajesh Bansal also talked about it in the opening keynote, that there is a certain amount of bias already there versus male versus female, right? Even with the same salaries, underwriting is being looked at in a different way. So what we can do is that to have counter that bias. Basically, if you look at account statement analysis and to expand that 2% into 1 to 6%, then you are able to make decision better. Same happens on, medium level of risk. Again, you can expand to basically 5 to 6 times, right? So this is the way you can use the technology to basically have that bias pinpointed and basically looked at very, very sharply compared to putting it in a bucket and saying that, okay, this is what the customer I don't want to deal with or I want to deal with. Yeah.
Thank you, Sachin. Kedar, same question to you, but you are seeing multiple organizations across multiple geographies. May not be live right now, but what are the kind of exciting use cases that you are seeing in the industry?
Yeah, I think the industry is going to explode with AI because when I think about it, finally, for everyone, we were discussing backstage what's the differentiation, right? And I think the differentiation axes are three key axes. One axis is about price. Can we provide the customer with a better price? Can we provide the customer with a better performance? And can we provide the customer with better service? Now, the power of AI is that one, it helps me, it impacts all these three axes. If you think about it, I'm able to significantly lower the cost of personalization or providing a personalized experience. We are able to bring out performance that couldn't be matched by most human teams, right? How do you make a decision on, say, someone's identity in a matter of few seconds, real time, right? If someone has not clicked a photo as the RBI would like it, how would you ask the user real time to say, hey, this photo won't be accepted by RBI. Why don't you follow these guidelines and take a better photo? So this kind of performance, it's impossible with any kind of a human system. And then the third part I mentioned was about service, right? So if I think about it, think about account verification, right? Which is a very basic process in every lending journey. If you ask me to do it using UPI, I'll be very happy. But my mom would not be able to figure it out at all. If you ask my mom to do using a checkbook or a passbook, she would be able to do it really well, but I have no clue where my checkbook or passbook is. I have never used it in the last maybe 1 or 2 years. So when I say service, if we know what the user is about and if we are able to dynamically personalize the experience basis the user, right? So the UI breaks, right? It's not like I'm going from one screen to the next screen to the next screen to the next screen, and that is a static, be it you or me, going through the experience, right? If there is a capability that the UI dynamically changes basis who is going through that experience, I think that's going to be a phenomenal opportunity. And then we don't have to remember where to click, where to press, which we all find so difficult getting trained on, because the UI is fluid and it is going to keep changing as per who the user is. So I think that's a brilliant opportunity, if I have to talk about one.
So what I get to hear from you, actually, any use case which will help in the customer experience, hyper-personalization, making segment n is equal to 1 to give the unique experience to the particular customer, such use cases would be the most important use cases for AI to tackle. Thank you so much. So, being mindful about the time, very quickly, we will touch upon, Rajesh, with you. Explainability has always been an issue, right? With the new wave of AI, the explainability is even a bigger issue. It's a technical challenge, right? And we know regulators in one form or another wants explainability. So your comments on explainability.
I think it's true for every new technology, but from a practitioner's perspective, I think we must understand that innovation and regulation, there will always be a lag. There is nothing to regulate till there is innovation and put to practice. But by the time it's put to practice, regulators come in and then suddenly all the practitioners are in a bit of a shock. I keep thinking about this cycle and I wonder why. What is so sacrosanct? We're talking about protection of personal information, usage of PII, etc. I think it's for the industry to be much more proactive as we introduce new technologies than to wait for regulation. I think that's my broad message, really.
Thank you, Rajesh. Sachin, a quick comment on this?
Well, yeah, I mean, just to quickly add on top of it, I mean, see, first of all, we are in the regulated industry and from bureau perspective, and then obviously when we use AI or ML, I mean, there are certain guidelines by RBI to have, which are similar in nature in terms of validation of models, empirical data, you have to prove that how did you really build it, or let's say, what are the steps involved, periodic checks, model validation. So I think from that perspective, regulatory framework is also going hand in hand. Obviously, it is not that anybody wants a surprise because it's a serious business. So from that point of view, I think as of today, whatever regulators are providing as a framework, within that we are able to work. But as the technology improves, I'm sure regulators will also open up and see that how we work together on that. Done.
Thank you, Sachin. Kedar, very quickly, how much of regulation you are seeing, governance from regulators and their concern globally in different markets? Very quickly.
I think all regulators are concerned, and as Rajesh sir mentioned, I think as innovation happens, then the edge cases happen, then the problems come, and the regulators have to work towards solving them. I think the only two things that all of us look for in the ecosystem is that the regulator is willing to understand or listen on why something is happening, and they're willing to give some time to make the necessary corrections. I think as long as that is there, all of us understand that with any new experiences, there are going to be some edge cases, there are going to be some bad experiences that happen with any innovation.
So what you were saying, that regulators are open to looking at this new technology, if I may say, and maybe take a step forward in understanding it better, whether new governance rules which are amenable, keeping the customer convenience in mind, can be taken forward.
And we are in a country which has the most entrepreneurial people. So I think regulators don't have a choice, right? I think this is a country that is producing amazing innovation. And I think in the next 20 years, we are going to see a lot more than what we have seen in the last 20.
Possibly, yes.
So I think the regulator will have to also buckle up.
Possibly, yes, of course, taking care of the systemic risk that always lurks in the dark in financial services industry. I'm sure that regulator will take the necessary steps.
Yeah. As a practitioner, the only thing that we follow, right, it's a very naive way of looking at it. Don't do anything that if it's on the front page of a Times of India or a Hindu, you will not like it.
Absolutely.
So just don't do anything like that, be it small or big. If it's on the front page, if we don't like seeing it, let's not do it.
Absolutely. Thank you. Thank you, Kedar. So I'll not take further time to really summarize. We have already overshot time. So if there are time for a couple of questions, we'd invite a couple of questions from the audience. Yeah.
Yeah, so I have a question for both the credit bureau chiefs here, right? So if you look at the actual experience, I'm trying to play the devil's advocate here. If you actually see the data, the fintechs and the NBFCs, which heavily have dependent on AI and ML, surprisingly in similar product categories compared to banks who use very traditional scoring models, they'll end up having much higher NPAs. Today, everybody knows fintechs in various segments have a much larger NPA. What is going wrong here? I mean, despite all the usage of AI, ML, better technology, they tend to have got this wrong, and perhaps the traditional banks, and especially Alma Mater, does a much better job, right, Rajesh? So, any color on that?
I probably wouldn't want to comment on an industry segment per se, but still to try and address some of your questions, Suresh. I think models are just tools. You can give me a Ferrari tomorrow. If I drive badly, I'm going to go crash, right? So to very simply answer your question, I think the credit philosophy at work, to my mind, that requires introspection. It's not just the models. After all, the models do what we make them do. I hope I've somewhat answered your question. Sachin?
No, exactly same. I mean, there are safest cars in the world, the most sophisticated, but it all depends on the driver, how you drive. So all the models, everything is there as a tool. At the end of the day, it's a risk appetite of a organization, the people who are working, their perception, their ability to sort of, and that's where banks are traditionally known to have a more conventional approach on risk, whereas the younger companies have a bigger risk appetite, and sometimes, it does backfire, yeah. So there's no specific answer for any specific company. That's a typically possibility. Yeah.
Yes, sir.
Chandrakant Salunke, President SME Chamber of India. Since both of you mentioned about SME, most of the financial institutions not providing the data on instantly or immediately. And a lot of entrepreneurs and particularly SME enterprises are facing problem when they approach for any financial assistance or support from the bank. So what is it now the technology has developed? Instant data is receiving by you, or how much time they are taking, and why the entrepreneurs are facing problem, end of the proposal, the bankers or financial institutions are taking report. What is your thoughts on this, both of you, Sachin and you?
I think very simply, this is an ecosystem issue. It's not to do with the bureaus, but in a more generic sense, to still take a minute on your question, the ecosystem is getting ready. GST data, I think, is very important. When you talk about SMEs, right, you talk about GST, it's hardcore trade information, right? And then smaller MSMEs, the EPFO data, how many employees, electricity bill is supposed to be a good surrogate to how the business is doing, right? In the absence of very reliable financials. Now, all this information is about the digital ecosystem of the country. All of this system is available, I think, with the account aggregator framework and the whole lot of other initiatives of the government. The effort really is to make consented data available more easily. Not all of this is going to come into the bureau or any one place. It's really about how we easen up the ecosystem for a customer to say, I am okay, I'm giving my consent to using my EPFO information or my GST trade data for the lender to take a better decision. Now, this process of providing consent, getting that information, processing that information for usage, all that we spoke earlier, I think that's where the current focus and the effort is. We have a very progressive government and regulators, and hopefully it's already available, maybe a little more fragmented, maybe still a little cumbersome as of now. I'm sure it's a matter of time before all of that is more easily and quickly available. That should solve a lot of the problems that we just mentioned.
So just to add, your point is very valid. And obviously, people want banks. I mean, if you look at it, the whole focus is that, they want to provide loan to someone wherein they are sure of what the data is telling them, right? So just to add here, traditionally what used to happen is that, see, if you see MSME, how they grow. I mean, they become like first a proprietorship company, then they become partnership, then they have private limited. Now there is a journey which they take over 10-year period. Now, traditionally, what has happened is that even a bank or NBFC, when they are doing underwriting, they typically, when they look at a bureau score or they look at peripheral data, and till they come to the GST layer, there is a lot has happened in their life, right? Now, today, we have a facility that banks and NBFCs can pull personal and commercial bureau together. So today, I mean, if I was basically a proprietorship company for 5 years, and then I moved to and I set up a business with my brother or my family members, or I did something else, today, banks and NBFCs do have that facility, which we can provide. So it is improving, and traditionally it was purely on a personal or on commercial, and that it used to give a half the picture, right? But yes, there is a lot of work to be done by everybody in the ecosystem, as Rajesh mentioned, and everybody needs to contribute to that sort of ecosystem data, and that's where MSMEs will get benefit of that.
Thanks, Rajesh, Sachin, and Kedar for your insights. Thank you.
Thank you, Gautam.